All right, let's talk about one of India's biggest retail success stories, Avenue Supermarts, which you probably know as DMART. Today, we're going to deconstruct a fascinating stock analysis that tells a tale of two halves. The story of a business that is, for all intents and purposes, nearly perfect, and a stock price that might be anything but.
So, where do we even begin? Let's start right here with this number, the share price. This tells you right away, we're not talking about just any company. This is a heavy hitter, a business the market takes very, very seriously. But the real question is, does it take it a little too seriously? Here's how we're going to break this all down. First, we'll look at why DMART is the undisputed king of value retail. Then, we'll dive into its winning formula, kind of like its secret sauce. After that, we'll check out its insane growth numbers before hitting the big dilemma, the price of perfection. We'll see how the analysts score the whole thing, and finally land on that crucial final question, to buy or not to buy.
Okay, so first things first, we need to understand just how massive DMART is. And when I say massive, I don't just mean a bunch of stores. We're talking about a real juggernaut, a company that has completely changed the game in Indian retail.
So what's their deal really? At its heart, it's super simple. They are masters of value. With over 330 stores spread across 12 states, their whole game is selling brands you know at prices that are just really hard to argue with. And how do they pull that off? Through an absolute obsession with being crazy efficient.
Okay, so how does it all actually work? What's the secret sauce here? Well, the analysis boils it all down into these three core pillars of success. This is the engine that drives the whole operation. First up, you've got everyday low pricing. This isn't about flashy sales, it's about prices that are just consistently low day in and day out. And that builds a ton of trust. Second, operational excellence. I mean, these guys are just relentless when it comes to making their supply chain efficient and keeping costs down. And pillar number three, a totally customer-centric approach. For them, it is all about convenience, quality, and of course, value.
And when you put those three pillars together, you get these incredible defenses, what investors like to call competitive moats. Think of it like a castle. Because they're so huge, they get better deals from suppliers. They sell stuff so fast their inventory turnover is amazing. Plus, they own a lot of their store locations, which keeps their costs locked down. It's a fortress, really, built on pure efficiency.
Okay, a great business model is one thing, but does it actually deliver the goods? Well, let's get into the hard data, because honestly, the numbers here don't just talk, they shout. This is where the story gets really, really impressive.
Check this out, 25.4%. That's their 5-year compound annual revenue growth? I mean, that's not just growth. That's a business that is absolutely on fire, expanding at an incredible clip year after year after year.
But wait, it gets even better. Look at this number, 28.1%. That's their 5-year compound annual profit growth. You see what's happening here? Their profits are actually growing faster than their sales. That is the sign of a machine that isn't just getting bigger, it's getting smarter and more efficient with every single sale.
And if you're still not convinced, just look at how they stack up against the competition. We're looking at return on equity here, basically how good they are at making money from their shareholders' cash. At 18.5%, DMART is just running circles around its peers. This truly proves they are the best in their class, no question.
So let's recap. Amazing business, killer execution, mind-blowing growth. Everything seems perfect, right? Well, this is where the plot thickens. We have to talk about the price you pay for all this perfection. And honestly, this is the billion-dollar question for anyone looking at this stock. So I'll ask you straight up. You've got this brilliant company, flawless execution, incredible growth. Does that automatically make it a perfect investment? It seems like an easy question, but the answer is anything but. Because, and this is so important, the company and the stock are two very, very different things.
And boom, here it is, the heart of the problem. When analysts look at a stock's price, they use these things called valuation metrics. PE ratio, PS ratio. Basically, different ways to ask, is this thing expensive? And for DMART, the answer across the board is a resounding and kind of brutal, poor.
Just to really drive this home, look at the price-to-earnings ratio. DMART is sitting at nearly 65, while the average for its sector is about 35. That's almost double. What that means is you're paying a massive, massive premium for DMART's profits compared to its rivals. You're basically paying today for the growth everyone hopes will happen years down the line.
All right, so we're stuck, right? On one hand, you have this phenomenal business. On the other, a sky-high price tag. So how do you make sense of that? Let's see how the analyst scorecard brings it all together, weighing the pros and the cons.
So the scoring system here is pretty detailed. You can see that financial health and growth prospects are the heavyweights, making up half the score right there. But everything else matters too. Competitive position, the quality of the management team, and crucially, valuation gets its own 15% slice of the pie.
And here it is, the whole dilemma in one simple table. The scores for the business itself? Fantastic. 8.5 for financial health and 8.8 for growth. Beautiful numbers. But then your eyes hit valuation, and it's a 4.8. Ouch! That one number just pulls the whole overall score down. And that brings us to the grand finale. The big question. How does an investor actually deal with this conflict between a great company and a high price? Let's get to the analyst's final verdict. To buy or not to buy?
It really boils down to two very different stories. The bulls will tell you, look, it's a dominant company with tons of room to grow, you can't go wrong. But the bears will fire back, the stock is priced for absolute perfection. There's zero margin for error, and what about online competition? And you know what? Both sides have a really good point.
So what's the call? The final recommendation is a hold. Now, let's be really clear on what that means. It's not sell. It's basically saying if you already own the stock, it's probably worth hanging on to it. But if you're thinking about jumping in now, well, you might want to wait for a better price.
So the verdict really boils down to this. Yes, without a doubt, DMART is one of the highest quality businesses in India. But, and it's a huge but, the market already knows this. The high stock price today has already baked in all the great things people expect it to do in the future. So the potential for big, quick gains, well, it's pretty limited.
And this quote from the report just sums up the whole dilemma perfectly. It says valuations appear stretched, but then immediately follows with, but may be justified by superior business quality. See? It's acknowledging the crazy high price, but also tipping its hat to the fact that, hey, maybe this company is just so good that it has earned it.
And that leads us with the ultimate investment puzzle, doesn't it? A perfect company at a very imperfect price. So it all comes down to a question you have to ask yourself as an investor. What premium are you willing to pay for pure, undeniable quality?